Hello, I'm delighted to be back with you for this new edition of Bordier's Monday Report. The conflict in the Middle East is entering its fifth week, and it seems risky to predict its duration. Indeed, the flow of news between the belligerents is particularly vague and ambiguous, even more so than usual during armed conflict. Economically, rising energy prices and visible disruptions in various supply chains are prompting many institutions to revise their outlook for this year. Growth revisions are in the range of 0.1 or 0.2% downward and plus 0.2 to 0.3% for inflation. At this stage, it remains relatively benign. A prolongation of the conflict would obviously have more serious consequences, especially if troops were sent into the field. But this geopolitical crisis comes at a time when the economic situation is still quite encouraging, allowing it, at least temporarily, to better absorb this shock. This was confirmed in part by last week's publication of the Purchasing Managers' Index in the United States and the Eurozone for March, after the conflict had already begun. On the left-hand chart, we have the American situation, and on the right-hand chart, what's happening in Europe. In March, confidence in the manufacturing sector rose more than expected in both regions. On the other hand, it fell in services, again on both sides of the Atlantic. But for now, what's reassuring is that the level of these four indices remains above the 50 threshold, so still in expansion territory. One consequence of the current crisis on financial markets is the rise in interest rates. The chart on the left clearly shows that this rise is widespread, affecting most developed markets to varying degrees. On the right-hand chart, we've broken down the rise in 10-year sovereign rates since the start of the conflict in blue between its real component in gray and its inflation component in red for the United States. The result may seem a little surprising. The rise in rates comes mainly from the rise in real rates and not from inflation expectations. This is even more penalizing for the economy and, in our view, is not sustainable. In fact, as we can see here, 10-year real rates in the United States are around 2.1%, a particularly high level over the last 20 years. So it's more of an entry point than an exit point. Over the past week, asset price volatility remained high. Equities were mixed, down nearly 2% in the US and emerging markets and up in Europe and Switzerland. 10-year sovereign rates rose by a few basis points, penalizing bond prices by 0.3 to 0.4% in dollars and euros. The dollar index appreciated by 0.5%, penalizing gold prices by 1.3%. Finally, oil prices rose by only 0.9% over the week, but with very sharp daily fluctuations. This week in the United States, we'll see the publication of the Manufacturing and Services ISM, as well as the March employment report. In the Eurozone, our focus will be primarily on the inflation figures for the month of March. That's all for today. Since next Monday, April 6th, is a public holiday, the Monday report will not be published. I wish you a good day and look forward to seeing you in 2 weeks.